Get ready because the news cycle is moving at warp speed, and you need to know what's happening right now. This is Qualcomm Pulse, and we're diving headfirst into the stories that are shaping our world. We've got major shakeups, government interventions, and financial maneuvers that could redefine industries. Don't blink because you might miss it. First up, we're tracking significant employment shifts in the tech sector, with major companies making impactful decisions that will resonate across regions. But that's just the tip of the iceberg. Then, we're dissecting a groundbreaking government deal involving a tech giant, sparking intense debate about its implications for national strategy and economic policy. Is this a bold move for progress or a step into uncharted territory? We'll break down the details. Plus, we're uncovering the financial intricacies of that major government tech investment, getting straight to the numbers and what they mean for the company's future. And finally, we're looking at how strategic government partnerships are being structured to influence the direction of critical industries. Stick around because you won't want to miss a single second of this. Subscribe, hit that notification bell, and let's get into it. Tech sector sees major job cuts amidst shifting economic landscape. In a significant development reflecting the dynamic nature of the technology industry, several prominent companies, including Intel, have recently announced substantial workforce reductions. These announcements come shortly after President Donald Trump revealed a notable government stake in Intel, a move that has already generated considerable discussion. Intel, specifically, has disclosed plans to eliminate nearly 200 jobs across its California operations. Warn letters filed with the State Employment Development Department on August 25 detail these cuts, with 98 positions being eliminated in Santa Clara and an additional 83 in Folsom. The timing of these layoffs, with initial scheduling centered around mid-July, has drawn attention, especially in light of the recent government involvement. According to a review of warn letters filed by Intel since 2023, these latest reductions contribute to a larger trend, bringing the total number of disclosed job cuts in the Bay Area to approximately 2,461 in recent years. The breakdown indicates 927 layoffs in 2023, 700 in 2024, and a projected 834 for 2025. Beyond Intel, other companies are also implementing significant staffing changes. Alameda-based biotech firm Exelixis is laying off 71 workers at its corporate headquarters, and San Leandro-based logistics provider Web2Door is eliminating 192 jobs across its facilities in Richmond, Milpitas, and Oakland, with plans to cease operations in these locations. Both Web2Door and Exelixis have indicated that these layoffs will become effective around October 27th. These widespread reductions highlight the ongoing adjustments within the tech and related sectors as companies navigate evolving market conditions and strategic priorities. The tech community is abuzz with reactions, with many looking to understand the broader economic forces at play and how these individual company decisions will impact the regional job market and the industry at large. But what does this government investment truly mean for the future of American chipmaking? Stay tuned as we delve into the implications of the administration's significant stake in Intel. Government takes significant stake in Intel, sparking national debate. In a move that has ignited widespread discussion and divergent opinions, President Donald Trump has announced that the federal government has acquired a 10% stake in American chipmaker Intel, positioning the government as its largest shareholder. This unprecedented decision by a Republican administration has been met with mixed reactions from the political spectrum. While some Republicans have voiced support for the initiative, viewing it as a strategic move to bolster domestic technology manufacturing and secure America's technological edge, others have expressed strong reservations, with some critics labeling the action as a form of socialism. The deal, which signifies a significant government intervention in a private enterprise, aims to strengthen the U.S. leadership in the critical semiconductor industry. This strategic alignment is part of a broader effort by the administration to exert greater control over key sectors of corporate America, ensuring national interests are prioritized in an increasingly competitive global market. The implications of this government ownership are far-reaching, raising questions about future policy decisions, potential conflicts of interest, and the overall economic model being pursued. Experts and commentators are weighing in on whether this partnership will indeed foster innovation and economic growth, or if it represents an overreach of government power into the private sector. The administration has framed the investment as a means to secure America's technological future and enhance its economic competitiveness on the world stage. However, the fundamental question remains: is this a prudent strategy for national advancement or a departure from traditional free market principles? The debate is ongoing, with significant economic and political ramifications to consider as the nation navigates this new frontier of government-industry collaboration. Analysts and the public are closely monitoring the situation, with many on social media platforms debating the long-term effects of government intervention in the tech sector and its potential impact on market dynamics and innovation. But beyond the political debate, what does this landmark deal mean financially for Intel and the government? We're breaking down the cash flow and the fine print next. Intel confirms $5.7 billion government investment amidst strategic realignment. Chip-making giant Intel has officially confirmed the receipt of $5.7 billion from the U.S. government, a substantial infusion of capital resulting from a recently negotiated deal that grants the federal government a 10% equity stake in the company. David Zinsner, Intel's chief financial officer, revealed the details at a Deutsche Bank technology conference, stating that the funds were received on Wednesday night. This transaction is a key component of the Trump administration's strategy to assert greater influence over the American technology landscape and reinforce the nation's dominance in semiconductor manufacturing. Zinsner highlighted that this capital injection serves as a crucial incentive for Intel to maintain control over its contract manufacturing division, known as its foundry. This was a quick way to getting, initially, $5.7 billion in the door, Zinsner commented, emphasizing that the funds have been recorded on the company's balance sheet, thereby alleviating the immediate need to access capital markets through other means. The agreement also includes a provision for an additional 5% warrant for the U.S. government should Intel's ownership in its foundry operation fall below 51%. Zinsner expressed confidence that this scenario is unlikely, anticipating the warrant will likely expire without being exercised. Intel has previously signaled its openness to external investment in its foundry business, which is currently governed by a separate management board. The company has indicated a preference for strategic investors over financial ones, though such a move is reportedly years away. Earlier this month, Intel secured $2 billion from SoftBank Group in an equity deal, as part of a broader restructuring aimed at reducing its workforce to 75,000. The $5.7 billion is part of Intel's allocated share from the U.S. CHIPS and Science Act funding. The government's purchase of 433.3 million shares at $20.47 per share represents a significant commitment. This follows earlier disbursements totaling $2.2 billion in CHIPS grants and an additional $3.2 billion from the Department of Defense's Secure Enclave program, bringing the total government investment to $11.1 billion. While the White House has characterized the deal as strengthening U.S. leadership in semiconductors, there have been conflicting statements regarding its finalization, with some officials suggesting certain aspects are still under discussion. Industry observers and investors are closely analyzing the financial implications, particularly how this government funding will impact Intel's competitive positioning and its ability to innovate in the foundry space. But this government stake isn't just about funding, it comes with strings attached. We'll explore how the deal is designed to influence Intel's business decisions next. Government deal structures incentives to retain Intel's foundry business. The Trump administration's recent deal with Intel, which secured the U.S. government a 10% equity stake in the semiconductor giant, includes specific provisions designed to influence the company's strategic decisions regarding its foundry business unit. Intel's chief financial officer, David Zinsner, shared details at a Deutsche Bank conference, revealing that the agreement is structured to penalize Intel if it chooses to spin out or sell its foundry operations within a specified timeframe. Specifically, the deal incorporates a 5-year warrant that would permit the U.S. government to acquire an additional 5% of Intel's shares at $20 per share if the company's equity in its foundry business drops below 51%. Zinsner expressed his expectation that this warrant will ultimately expire without being exercised, suggesting Intel's intent to maintain control. I think from the government's perspective, they were aligned with that. They didn't want to see us take the business and spin it off or sell it to somebody, Zinsner stated, underscoring the administration's objective to keep the foundry unit integrated within Intel. As a result of this agreement, Intel received $5.7 billion in cash, sourced from previously awarded but not yet disbursed grants under the U.S. CHIPS and Science Act. This move underscores the administration's commitment to bolstering domestic chip manufacturing, especially as many industry players increasingly rely on offshore production facilities like Taiwan's Semiconductor Manufacturing Company. However, the warrant structure also presents a challenge for Intel, potentially obligating the company to retain a business unit that has been a significant financial drain. Intel Foundry reported an operating loss of $3.1 billion in the second quarter, and its future has been a point of contention among analysts, board members, and investors, with some advocating for its spin-off. The departure of former CEO Pat Gelsinger, who was instrumental in the Foundry's strategy, further complicated these internal discussions. The administration's approach, while aiming to strengthen national semiconductor capabilities, imposes conditions that could limit Intel's operational flexibility and financial decision-making regarding its underperforming foundry segment. This strategic intervention highlights a broader trend of governments seeking to guide and control critical industries for national security and economic competitiveness. Industry analysts are closely examining the long-term implications of these contractual obligations, questioning whether they will foster necessary innovation or create unforeseen hurdles for Intel's recovery and growth. And that wraps up our deep dives for today. But before you go, let's hit the highlights one last time. And that's a wrap on today's pulse-pounding updates. We've seen major tech companies making tough decisions about their workforce, the government making bold moves in the semiconductor industry, and intricate financial deals being inked. Make sure you like this video, subscribe to Qualcomm Pulse for more essential news, and ring that notification bell so you never miss an update. Follow us on all social platforms to keep the conversation going. We'll see you in the next one.